Welcome back to the Deep Dive, where we cut through the complexity to bring you the essential insights buried in the reports. Today, we're plunging into the latest numbers from a genuine heavyweight in the global leisure, hospitality, and frankly, a whole lot more seen, Genting Berhad.
It really is. A company with such a vast footprint, extending far beyond the integrated resorts many people might think of first. Analyzing Genting Berhad is, well, it's complex precisely because you're looking at this sprawling conglomerate with really diverse operations all around the globe.
Exactly. And you might remember we've actually done a deep dive into Genting Malaysia before. Well, Genting Berhad is the parent company. It pulls together all the results from operations in Malaysia, Singapore, the US, the UK, and even dips its toes into energy, plantations, oil and gas.
That's right. So when you look at the Genting Berhad numbers, you're seeing the consolidated picture, the sum of all these very different moving parts.
So if you've been following along, maybe looking at the share price lately and scratching your head wondering, as one source put it, why your stock keeps crashing. Well, this deep dive is specifically designed to help you understand some of the financial realities and underlying performance dynamics that might be contributing to that picture.
Precisely. Our mission today is to really unpack Genting Berhad's first quarter 2025 results. We'll be sifting through the figures provided in the sources you've shared, the official company press release, analyst reports from HLE, Public Investment Bank, TA Securities, and some extra context from a YouTube analysis.
We need to go beyond just the headlines, right?
Absolutely. We need to understand what these numbers truly tell us about their recovery trajectory, the specific challenges they faced in this quarter, and what the company and the analysts think might be coming next. We're going to pull out those crucial nuggets of knowledge for you so you can become really well informed on Genting Berhad's recent performance.
All right, let's get into it. Let's start with the big picture, the consolidated financial performance for the first quarter of 2025. How did the group do overall, especially when we compare, say, the first 3 months of this year, Q1 2025, to the same time last year, Q1 2024, and maybe also to the quarter just before, Q4 2024? Getting that top-line view first seems like the right place to start.
Okay, sounds good. So looking at the group's top line, the revenue for Q1 2025 came in at RM 6,508.0 million. Now, comparing that to the same quarter last year, Q1 2024, the company's own press release states that revenue was RM 7,431.3 million then.
Okay.
So that comparison shows a decrease of 12% year on year.
Yeah.
It's worth noting, one of the analyst reports, HLIB, used a slightly different figure for Q1 24 revenue, RM 7,570.3 million, which would mean a 14% decrease.
Yeah.
But let's stick to the 12% drop the company cited against its own Q1 24 figure from their release. Is there not?
Right, okay. So a noticeable step back compared to a year ago. How did that revenue figure look compared to the quarter right before it, Q4 2024?
Against Q4 2024, where revenue was RM 7,092.5 million, the Q1 2025 figure of RM 6,508.0 million represents an 8.2% decrease. So yeah, revenue was down both compared to the prior year and compared to the end of last year.
And did the company pinpoint one main reason for that year-on-year decrease? Where did they say the drag was coming from?
Yes, the press release was actually quite explicit about this. It states that the decrease in revenue compared to Q1 24 was, and I quote, contributed mainly by the leisure and hospitality division.
Okay.
So that's a key point right away. The core business segment seems to be the primary driver behind the overall group revenue decline in this first quarter.
Okay, that's revenue. Now let's shift to profitability. How about adjusted EBITDA? That usually gives us a clear view of the operational performance, doesn't it? Stripping out things like interest, tax, depreciation.
Exactly. It cuts through some of the noise. So the group's adjusted EBITDA for Q1 2025 was RM 1,990.6 million, compared to Q1 2024's RM 2,507 year lower by 23%.
23%? Wow.
Yeah. And HLF Research's report backs this up. They cited a 22.7% drop against that same RM 2,574.0 million figure. So a substantial decline.
Ouch, yeah. A 23% drop in operating profit year on year is definitely substantial. But how did it look compared to the quarter just before, Q4 24? Did it follow the revenue trend?
Actually, no. This is where we see a different and more positive trend. Against Q4 2024's adjusted EBITDA of RM 1,679.0 million, the Q1 2025 figure of RM 1,990.6 million is actually higher by 19%.
Oh, interesting.
So while operating profit took a big hit compared to what seems like a strong Q1 2024, it saw a notable recovery and improvement coming out of the fourth quarter of last year.
That is interesting. The trend looks quite different depending on which period you compare it to. Okay, let's drill down to the bottom line then the profit or loss for the period, the statutory net profit figure.
Right. The reported profit for the period in Q1 2025 was RM 277.6 million. Now, compared to the RM 998.6 million reported in Q1 2024, this is a very steep decline. It represents a 72% drop year on year.
72%.
Yeah. However, looking at the quarter-on-quarter trend, it's a significant turnaround and improvement from Q4 2024, which actually reported a loss of RM 155.2 million for the period.
Okay, so 72% lower profit year on year, but swinging from a loss in the prior quarter to a profit this quarter. That's quite a dramatic swing in recent performance. How did that translate down to earnings per share for the shareholders?
Well, basic earnings per share for Q1 2025 was just 0.12 cent. Tiny.
Very small.
It's down dramatically from 15.29 zen in Q1 2024, which is a 99% decrease year on year. But again, similar to the overall profit figure, compared to the loss of 4.4 zen per share they booked in Q4 2024, it's a significant improvement, moving back into positive territory.
Okay, so the official reported profit was RM 277.6 million. But I noticed one of the analyst reports, TA Securities, mentioned something called core profit. And that figure was much lower, apparently coming in below what the market expected. What's the story there? What's the difference?
Yeah, that's a really important distinction to make. Yes, TA Securities specifically highlighted that Genting Berhad's Q1 25 core profit was significantly lower at just RM 76.9 million. And they explicitly stated that this figure came in below market expectations.
And why was that?
They attributed this earnings miss largely to lower than expected contribution from the gaming operations, specifically across Singapore, Malaysia, the UK, and Las Vegas. The difference between the official reported profit, that RM 277.6 million, and what analysts call core profit, is that core profit usually strips out things analysts consider non-recurring or non-operational.
Like what?
Things like fair value adjustments, impairments, maybe gains or losses from selling assets, or other one-off items that they feel don't reflect the company's underlying ongoing operational performance. So while the official reported profit swung back positively quarter on quarter, the core operational profit, the number analysts often use to gauge the fundamental health of the business, was actually quite a bit lower, and importantly, it disappointed relative to what the market was expecting from those key gaming units.
That distinction is crucial, especially for understanding how the analysts might react later on. Now, you mentioned earlier that the overall decline in revenue and EBITDA was mainly down to leisure and hospitality. But the press release also hinted at something about currency fluctuations impacting the results, didn't it?
Yes, absolutely. And that's a really crucial factor to understand when you're looking at these consolidated numbers for a global company like Genting. Both the company press release and the HLUB source specifically note that the strengthening of the Malaysian ringgit, the RM, against other currencies they operate in, like the Singapore dollar, SGD, the British pound, GBP, and the US dollar, USD. Well, that strengthening partly contributed to decreased revenue and adjusted EBITDA of the group when you compare Q1 2025 to Q1 2024.
Okay, so what does that mean in practical terms?
It means that even if the local currency performance in some of their overseas markets, say Singapore, the UK, or the US, might have been stable or even improved, when those results are translated back into Malaysian ringgit for the consolidated report, a stronger ringgit automatically result in a lower ringgit value being reported.
Right.
So some of that reported year-on-year decline isn't necessarily because the business performed worse in those actual markets. It's partly just an accounting effect from the unfavorable foreign exchange translation. It's like, earning the same amount in euros, but if the US dollar gets much stronger when you convert it, you end up with fewer dollars.
That definitely adds another layer of complexity to interpreting these numbers. So what do these top-line consolidated numbers immediately tell you, the listener?
It looks like Genting Berhad faced a really tough comparison against what seems to have been a very strong first quarter of 2024. That resulted in a significant step back in both revenue and profitability year on year.
But they saw a notable recovery from what must have been a challenging end to 2024, swinging from a loss back to a profit and improving EBITDA quarter on quarter. Crucially, though, analysts noted that the core operational profit was below expectations, primarily blaming the gaming segments for that miss.
And don't forget the currency effect.
And yes, absolutely, let's not forget that the strengthening ringgit was masking some of the local currency performance in those important overseas markets. It's clearly a mixed bag right at the top level, isn't it? Which signals we definitely need to dig much deeper into the individual segments to see what's really going on beneath the surface.
Absolutely. The consolidated numbers are really just the starting point. To understand the drivers behind these trends, especially that significant year-on-year dip, we need to, transition now and unpack the performance segment by segment. We need to identify exactly which parts of this vast Genting business empire are really driving these results and how their different operations are actually faring.
Right. Let's do that deep dive into the leisure and hospitality segment first. Since the company themselves highlighted it as the main contributor to that overall revenue drop, this is the part of the business most people associate with Genting, I think.
Okay. The leisure and hospitality segment's overall revenue in Q1 2025 was RM 5,341.5 million. Now, this was down 17.6% year-on-year from the figure cited in the HLAB source for Q1 2024 LNH revenue, which was RM 6,480.8 million. And it was also down 3.5% quarter-on-quarter from Q4 2024's RM 5,534.5 million.
So that confirms it then. LNH was the primary drag on the group's consolidated revenue.
Yes, it definitely confirms that.
And how did profitability look within LNH itself, adjusted EBITDA?
Overall, LNH adjusted EBITDA was RM 1,659.6 million in Q1 2025. This showed an even steeper year-on-year decline than the revenue, dropping 32.8% compared to Q1 2024's RM 2,469.2 million. It increased 5.3% compared to Q4 2024's RM 1,575.7 million.
Okay, so within the core LNH segment, we see that same pattern. A significant year-on-year drop, but a positive quarter-on-quarter improvement. LNH is clearly the key driver of the overall decline. Let's break it down further by region to understand the different dynamics at play. Starting with Malaysia, home to Resorts World Genting, operated by Genting Malaysia, the subsidiary we looked at in a previous deep dive.
Right. Resorts World Genting, or RWG in Malaysia, reported revenue of RM 1,620.1 million in Q1 2025. This was down 7.2% year-on-year from Q1 2024's RM 1,746.0 million. And it also saw a decrease quarter-on-quarter, down 8.8% from Q4 2024's RM 1,766.1 million.
Okay, and EBITDA for RWG?
Adjusted EBITDA for RWG was RM 633.1 million, and a smaller dip of 3.3% quarter-on-quarter versus RM 662.8 million.
So Malaysia also saw a decline in both revenue and EBITDA then. What reasons did the company give for this performance in Q1 25? Any specific factors?
Yeah, the press release commentary noted that the lower revenue year-on-year was primarily due to the timing of the festive season in Q1 25 compared to Q1 24, and also lower business volumes, specifically in the premium player segment.
The high rollers.
Exactly. The lower EBITDA was largely a consequence of this lower revenue, although the percentage drop in EBITDA was slightly larger than the revenue drop, suggesting maybe some margin pressure too. In terms of focus, management for RWG is centered on enhancing its appeal, introducing new facilities, attractions, developing ecotourism experiences. They're also leveraging their 60th anniversary with special events and promotions.
Makes sense.
Operationally, they're concentrating on improving yield management, overall operational efficiencies, service delivery, alongside, of course, cost management and marketing strategies specifically aimed at getting more people through the doors, increasing visitation numbers. This all aligns pretty well with some of the strategic initiatives we discussed in our deep dive into Genting Malaysia's own performance, given that RWG is really their flagship property.
Okay, moving on to Singapore then. Home to Resorts World Sentosa, or RWS, operated by Genting Singapore. This property is often highlighted as a major profit engine for the entire group, isn't it? How did RWS perform in the first quarter?
Yes, it's usually a huge contributor. Singapore's RWS reported revenue of RM 2,065.8 million in Q1 2025. Now, this was a segment that experienced the steepest year-on-year revenue decline among all the leisure and hospitality regions. It dropped significantly by 25.3% from what must have been a very strong Q1 2024 figure of RM 2,764.7 million.
Wow, that's a big drop.
It is. However, looking at the quarter-on-quarter trend, it actually saw a modest increase, up 2.4% from Q4 2024's RM 2,017.5 million. Adjusted EBITDA for RWS was RM 797.3 million. It also showed the steepest year-on-year decline, down 39.7% compared to RM 1,323.3 million in Q1 24. But a very significant year-on-year drop in Singapore, both revenue and EBITDA. What were the specific factors driving that steep decline? Did they break it down? Yes. The press release attributed the lower year-on-year results for RWS to several key factors. Firstly, a lower VIP rolling win rate in the quarter. Just to clarify for listeners, the VIP rolling win rate is basically the percentage of the amount wagered by VIP players that the casino keeps as winnings. It can be pretty volatile quarter to quarter.
Right, it's luck-based to some extent.
Exactly. Secondly, the temporary closure of the Hard Rock Hotel for renovation. That directly reduced their available hotel room inventory and thus their revenue capacity. And thirdly, they cited a significant high base effect from Q1 2024. Apparently, that quarter saw exceptionally strong visitorship and tourism spending, boosted by the timing of the Chinese New Year festive season back then, and also the relaxation of visa regulations between China and Singapore in February 2024.
Oh, okay.
So Q1 25 was simply comparing against a very strong, perhaps unusually strong performance in the prior year. And that was made worse by a less favorable VIP win rate this time around, plus the disruption from the hotel renovation.
That high base effect makes a lot of sense. Coming off a stellar quarter can make the current performance look weaker, even if it's otherwise solid. What about the slight quarter-on-quarter improvement in RWS then? What drove that?
Well, the quarter-on-quarter increase in revenue and EBITDA did benefit from the Chinese New Year festive season falling within Q1 25 itself, so some seasonal strength there. However, they did note that the non-gaming business actually experienced softer demand quarter-on-quarter.
And why was that?
They attributed this to the continuous impact of the strong Singapore dollar, which makes Singapore a relatively more expensive destination for tourists using other currencies, and also the ongoing renovation and upgrading works. Those are part of the major RWS 2.0 transformation project, causing disruption. So while the gaming side saw a bit of a seasonal boost, the non-gaming side was feeling the pinch from currency strength and all the construction work going on.
RWS 2.0, that's that massive multi-year investment project, right? What did the report say about its progress, and what's management's strategic focus for Singapore now?
Yeah, it's a huge undertaking. Yeah. Management emphasized that RWS is continuing its, what they call, bold transformation journey. They've got a slate of high-impact projects planned for 2025 and beyond. The strategic goal is really to reposition RWS to sustain its position as Asia's premier lifestyle destination. They plan to do this by rolling out new attractions, experiences, programs.
What kind of things specifically?
Well, they specifically mentioned the recent launch of Weave, which is described as a vibrant lifestyle enclave for retail and dining, featuring over 40 stores, including some new F&B concepts. Construction has also apparently begun on the RWS 2.0 waterfront complex. That's a major part of it, including 2 new luxury hotels, a 4-story retail, entertainment, and dining podium, and even a distinctive light sculpture. And the renovation of the former Hard Rock Hotel is also part of this. It's expected to relaunch as a new all-suites luxury hotel early in 2025. The reports also mentioned previously that new attractions like Minion Land, the Singapore Oceanarium, and the Central Lifestyle Connector were on track for phased openings starting from Q1 25, and this latest report implies that progress is ongoing.
So the strategy is clear. Invest heavily now, accept some near-term disruption from all the construction and closures, but the aim is to create a significantly enhanced and more competitive integrated resort for the future.
That's exactly the picture. It's a long-term play involving significant upfront investment and disruption.
And what about potential regional competition? Anything mentioned there?
Yes. One analyst source specifically noted that GENS, Genting Singapore, is closely monitoring developments regarding the potential legalization of casinos in Thailand. That was approved in principle earlier this year, I believe, and it's an ongoing development. It could definitely introduce new regional competition that Genting Singapore is, quite rightly, keeping a very close eye on.
Okay, good to know. Let's look at the UK and Egypt businesses now. How did they fare in the first quarter?
The UK and Egypt segment reported revenue of RM 413.4 million in Q1 2025. This was down 6.6% year-on-year from RM 442.4 meters, and also down 7.4% quarter-on-quarter from RM 446.4 meters. Adjusted EBITDA came in at RM 55.5 million. That was a drop of 24.9% year-on-year compared to RM 73.9 meters, but it actually saw a small positive uptick of 0.5% quarter-on-quarter versus RM 55.2 meters.
Okay, another segment showing a decline year on year, though maybe less steep than Singapore's. What was the reason cited for the drop here? Was it FX again?
Yes, exactly. The press release commentary for UK and Egypt stated that the lower revenue year-on-year was, again, due to the strengthening of the Malaysian ringgit, this time against the British pound. That FX translation effect hitting the reported results again. Importantly, though, they mentioned the revenue in local currency was actually relatively flat year-on-year. This flat local currency performance was due to a strong hold percentage, which offset lower business volumes. Similar to Malaysia, they said it was also affected by the timing of the festive season. The lower EBITDA year-on-year, however, was primarily attributed to higher operating and payroll-related expenses in Q1 25.
Higher operating costs. That seems to be becoming a recurring theme across different regions, doesn't it?
It does seem that way, yes. Cost pressures appear to be a factor in several markets.
So how is management in the UK and Egypt businesses responding to this challenging environment?
Management's focus here is described as maintaining a, quote, vigilant and adaptable approach, given what they call a challenging operating environment. They're actively looking for revenue and growth opportunities while, crucially, strictly maintaining cost discipline. They're also focused on strengthening their capabilities and competitiveness and investing in what they call their core casinos to try and grow market share.
Okay, makes sense. Let's move across the pond now to the U.S. and Bahamas. This covers properties like Resorts World New York City, Resorts World Bimini, and the big one, Resorts World Las Vegas.
Yeah.
What were the numbers for this significant segment?
Right, a very important segment for them. This segment reported revenue of RM 1,242.2 million in Q1 2025. This was down 18.7% year-on-year compared to RM 1,527.7 meters, and also down 4.0% quarter-on-quarter versus RM 1,294.5 meters. However, the adjusted EBITDA for this segment showed a very different pattern quarter-on-quarter compared to revenue.
Oh, how so?
Adjusted EBITDA was RM 166.2 million in Q1 25. Now, that was down significantly year-on-year by 51.0% compared to RM 338.9 meters.
Yeah.
But, and this is the interesting part, it showed a massive jump of 101.0% quarter-on-quarter compared to just RM 82.7 million in Q4 24.
Wow, 101% quarter-on-quarter jump in EBITDA. That is a huge swing. What's driving that significant year-on-year drop on the one hand, but then that massive Q-o-Q jump on the other?
Well, similar to the UK segment, the lower revenue year-on-year was partly due to the strengthening of the Malaysian ringgit against the US dollar, another instance of that FX translation impacting the reported results in ringgit.
So local performance was better?
Yes, the press release explicitly states that revenue in local currency actually increased year-on-year. This was driven by improved operating performance across both Resorts World Omni, which is part of their New York operations, and RW Bimini. So the underlying local business performance in the U.S. Bahamas was actually better year-on-year. But the FX conversion pulled the reported ringgit figure down significantly.
And the lower EBITDA year-on-year, was that costs again?
Yes, again, mainly attributed to higher operating and payroll-related expenses, similar to what was seen in the UK segment, suggesting those cost pressures are being felt in the U.S. operations too.
Okay, but what about that huge quarter-on-quarter EBITDA jump? That's quite a turnaround from Q4 24. What caused that?
The press release commentary on the quarter-on-quarter performance is a bit less detailed than the year-on-year analysis, but it notes that RWLV's revenue and EBITDA reflected seasonality and hold percentage. Remember, hold percentage is the amount the casino wins from players.
Yeah.
Like the VIP win rate, it can fluctuate quite a bit.
Right.
So this suggests that a combination of seasonal factors inherent to the U.S. market may be weaker performance around the year-end holidays in Q4, followed by a pickup in Q1, combined with perhaps a particularly favorable hold percentage in their Las Vegas operations, contributed significantly to that very strong quarter-on-quarter EBITDA increase. For RWLV specifically, they noted hotel occupancy in Q1 25 was 82.3% with an average daily rate ADR of USD 274. That was slightly lower than Q4 24's 83.6% occupancy and USD 286 ADR. So the big EBITDA jump seems more tied to gaming performance, especially that hold percentage, and perhaps performance across the entire segment, including New York and Bimini, rather than just RWLV's hotel metrics alone.
Got it. What's the strategic focus for the U.S. business now, particularly given the competitive landscape there and the ongoing New York casino license process we hear so much about?
Well, in the U.S., management is really focused on solidifying its position in what is a very competitive New York gaming sector. A significant point mentioned is the expected completion of Genting Malaysia's acquisition of the remaining 51% interest in Empire Resorts, LLC. That's the deal from Keenwatt Realty Third Limited, which is a related party We'll touch on that structure later.
Okay.
Once that deal gets regulatory approval from the New York State Gaming Commission, Empire will become an indirect, wholly owned subsidiary of GENM. Management believes this move is highly strategic because it will allow them to fully realize synergies between RWNYC and Empire's assets, things like cross-marketing, sharing resources, sharing knowledge. This consolidation is clearly intended to strengthen G&M's competitiveness in that potentially massive northeastern U.S. market.
And the new licenses.
Yes, they are also actively preparing to participate in the New York Gaming Facility Board's Request for Applications, or RFA, process. That's for up to 3 new commercial casinos downstate. It's a major potential growth opportunity that they are definitely targeting.
And what about their plans for Las Vegas and the Bahamas properties?
For Las Vegas, RWLV, they're anticipating strong visitor volume in 2025, helped by citywide events and conventions. A key positive development they mentioned is the finalization of a complaint filed by the Nevada Gaming Control Board, the NGCB, back in March 2025. Resolving this is expected to allow RWLV to, quote, recover and reestablish VIP play.
Ah, that's potentially significant for the high end.
Exactly. They're apparently already seeing signs of improvements in high-end play with increased table volumes.
Right.
They also anticipate improvements in ADR and occupancy in 2025. They're putting this down to investments in an upgraded hotel management system, which lets them own the customer database for real-time offers and better guest experiences, and also an upgraded casino offer management system aimed at yielding a stronger customer mix.
So better tech driving better business.
That seems to be the plan. Their overall focus for RWLV is on improving margins through strategic growth and operational efficiencies. They want to actively grow high-end hosted casino play, enhance their casino and resort marketing, and strengthen their convention business. They're also investing in new dining, entertainment, and retail options there.
And Bimini.
In the Bahamas, RW Bimini, the focus is on driving visitation. They plan to do this by expanding their cruise strategy, getting more ships to call the port, and also by intensifying marketing and promotions. There's potential for an increase in airlift from Miami late in 2025, which could help. But the core focus for Bimini remains on optimizing operations and, importantly, controlling costs.
Okay, that provides a really detailed look at the leisure and hospitality division. It's clearly a complex picture with different dynamics in each region, isn't it? Singapore facing those tough comparisons and renovation impacts, Malaysia dealing with festive timing and softness in the premium segment, UK Egypt and US Bahamas impacted by unfavorable FX but seeing some underlying local currency revenue improvement, though offset by those higher operating costs we talked about.
Right. And specific operational wins, like resolving that RWLV NGCB issue, potentially allowing recovery in VIP play, seem to have contributed to that strong U.S. Bahamas quarter-on-quarter EBITDA jump.
Definitely. Let's quickly touch on the performance of the other non-leisure and hospitality segments now. They're important for the group's diversification, even if L&H is the biggest piece.
Right, absolutely. These segments are smaller contributors than L&H overall, but they're still significant parts of the conglomerate and, as you say, important for diversification. Let's run through them quickly. First, power. This segment reported revenue of RM 259.9 million in Q1 25. That was up a significant 56.1% year-on-year, although it was down 25.5% quarter-on-quarter. Adjusted EBITDA was RM 63.9 million, which is up an impressive 78.5% year-on-year, but down 53.5% quarter-on-quarter. The commentary expects steady performance from their Indonesia coal plant, positive contributions from the China JV, and favorable performance from their India wind farm, especially with the high wind season approaching from May to August. That strong YoY growth is definitely notable.
Okay, power looks strong year-on-year. What about plantations, operated by Genting Plantations or GENP?
Right, plantation, GNP. Revenue was RM 693.4 million. That was down slightly, 2.8% year-on-year, and down more significantly, 32.6% quarter-on-quarter. However, adjusted EBIT was RM 243.3 million. This showed strong growth, up 66.5% year-on-year, although it was down 11.9% quarter-on-quarter. Prospects here obviously track palm product prices and fresh fruit bunch FFB production. Prices apparently eased, but are expected to stabilize near term, and they expect overall growth in FFB production over the rest of the year. They did note that their downstream manufacturing segment within plantations remains challenging due to competition and export levies in Indonesia.
Interesting that EBITDA was up so much year on year despite slightly lower revenue.
Yeah, it suggests either much better cost management compared to last year or maybe more favorable price realization dynamics within their cost structure, or perhaps both.
Okay, next.
Oil and gas. Revenue here was RM 101.5 million. That was down 12.2% year-on-year, but up 6.6% quarter-on-quarter. Adjusted EBITDA was RM 71.7 million, which was down 15.4% year-on-year, but up 12.0% quarter-on-quarter. The outlook is positive on their China block, Xingdaxi, despite expecting lower contribution in Q2 due to declining crude oil prices mentioned in the press release. In Indonesia, discussions for a gas sale agreement for the Kasuri block are ongoing, and engineering work for the onshore gas processing plant is progressing. The big project here is the FLNG, the floating liquefied natural gas facility. Construction is progressing, reaching about 54% completion, and crucially, project financing discussions are ongoing, targeting finalization before the end of 2025.
That FLNG project sounds like a major undertaking. What else?
Just a couple more small ones. Property. Revenue was RM 51.0 million, down 12.7% YoY and 14.7% UOQ. Adjusted EBITDA was RM 12.2 million, down 26.9% YoY, but showing a very strong jump of 149.0% UOQ. And finally, investments and others. Revenue was RM 60.7 million, showing big increases both YoY up 72.0% and QOQ up 139.0%. Adjusted EBITDA was actually a loss of RM 60.1 million, but this represented a very significant improvement compared to the much larger losses they booked in Q1 24, RM 178.6 meter loss, and Q4 24, RM 379.3 meter loss. One source mentioned that FX translation losses on USD borrowings hit this segment's EBITDA hard in Q4 24, so the big improvement here might reflect less negative FX impact in Q1 25 compared to those challenging prior periods.
Okay, so while leisure and hospitality was definitely the main reason for the overall group decline compared to last year, it's clear that the story wasn't the same across the entire conglomerate, was it? Some of those other segments, like power and plantation, actually showed really strong EBITDA growth year on year, helping to kind of cushion the blow for the group overall. Even if their revenue trends varied, it really highlights the value of having that diversification within the group.
Absolutely.
Now, you mentioned earlier that higher operating and payroll expenses were impacting EBITDA in some regions like the UK and US. What can we gather about the overall margin drivers for the group in Q1 2025 based on the source commentary? What squeezed the profits?
Based on the commentary we have from the sources, the lower overall group adjusted EBITDA margin in Q1 2025 seems directly linked to a lower L&H segment EBITDA margin overall. The press release commentary explicitly pointed to those higher operating and payroll-related expenses impacting EBITDA in the UK and US L&H segments, even in the US, where local currency revenue was actually up. Then you had the lower VIP rolling win rate and the temporary Hard Rock closure in Singapore, which also directly impacted RWS's EBITDA margin.
So multiple factors hitting L&H margins.
Yes. It seems these cost pressures and specific operational factors within the core L&H business, combined with those unfavorable FX translation effects hitting the reported revenue, were significant drivers of the lower overall margin year on year. They appear to have outweighed the improvements we saw in the EBITDA margins of some other segments, like power and plantation.
So, what does this granular segment-by-segment look tell you, the listener? Well, while the headline numbers showed a dip compared to last year, especially in revenue and EBITDA, digging into the segments reveals a much more nuanced story. Singapore, usually a powerhouse, had a particularly tough quarter year on year due to specific, maybe temporary factors like renovation disruption, that high base effect from last year's strong performance, plus the luck factor of VIP win rate volatility.
Right.
Meanwhile, other areas like Malaysia and Egypt also saw declines linked to things like festive timing and FX. But the US Bahamas actually saw local currency revenue growth despite FX headwinds, although that was offset by higher costs. And remember, the quarter-on-quarter trend across most L&H regions and the group as a whole was actually positive, signaling maybe some recovery momentum coming out of the end of 2024.
It's like peeling back the layers of an onion, isn't it? The overall picture is one thing, but the details show where the pressure points are, like in Singapore, and where there are signs of underlying improvement or strength, like in the U.S., local performance or those power and plantation EBITDA contributions.
Definitely. Understanding the operational performance is absolutely vital, but we also need to look at the company's financial structure. How are they managing their debt? And critically, where are they putting their significant capital to work through investments? Let's shift gears now and look at debt, liquidity, and capital allocation.
Good idea. Debt is often a key focus for large, capital-intensive companies like Genting, especially when they have significant investment projects underway, like RWS 2.0.
Exactly. So what does the balance sheet tell us about their debt position as of the end of the first quarter, March 31st, 2025?
Okay, looking at the condensed consolidated statement of financial position as at March 31st, 2025, their total liabilities stood at RM 51,184.482 million. That's just over 51 billion ringgit. This is actually slightly down from the RM 51,601.696 million they reported at the end of December 2024. So a small decrease in total liabilities over the quarter.
How does that break down between short-term and long-term?
Right. Current liabilities, which are due within a year, were RM 10,925.497 million. That's up just slightly from year-end. And this includes RM 3,354.865 million in short-term borrowings. Non-current liabilities, those due in over a year, were RM 40,259.065 million, which is down a bit from RM 40,719.936 million at year-end. This includes their long-term borrowings.
Okay. Do we have an overall debt figure? I think one source mentioned some figures for the end of 2024.
Yes. The YouTube source provided some aggregate debt figures, specifically as of FY 2024. It noted that total debt had jumped significantly to RM 40.41 billion, and net debt stood at RM 17.13 billion at that point. Now, the Q1 25 report itself doesn't update these specific aggregate net debt figures for the quarter, but the balance sheet details showing the slight decrease in total liabilities and the changes in the borrowing components since year-end suggest that the overall debt level remains substantial, likely in that same ballpark.
And what about the cost of carrying all that debt? One source mentioned high finance costs were impacting profits back in 2024. How did that look in Q1 25?
Yes. The statement of comprehensive income shows their finance cost was RM 496.1 million in Q1 2025. Now, while that's still a very significant figure, nearly half a billion ringgit just in interest, it was actually down slightly compared to RM 528.0 million in Q1 2024, and also down from RM 513.4 million in Q4 2024. So yes, the cost of borrowing remained high, contributing significantly to their expenses, just as the YouTube source highlighted for 2024. But the expense itself did decrease modestly this quarter compared to the prior periods.
Okay, slightly better, but still a big number. Do the sources provide any specific details on our liquidity position, like cash on hand or their broader debt management strategy? Any refinancing plans mentioned?
The balance sheet does show cash and bank balances listed within current assets, indicating their available cash holdings. But the sources we have don't provide specific liquidity ratios like a current ratio or quick ratio, nor is there detailed commentary on their overall liquidity management strategy explicitly laid out in the Q1 25 report itself. Regarding debt strategy or refinancing plans, the report does mention a material event that happened subsequent to the quarter end. A subsidiary of Genting Plantations, called Genting Berhad, successfully issued RM 300 million in Sukuk Murabaha. Those are Islamic medium-term notes on April 28, 2025.
Okay.
This indicates ongoing activity in managing their financing profile, at least for specific subsidiaries. Also remember the big FLNG facility in the oil and gas segment? The report confirms that project financing discussions for that are in progress, and they're targeting finalization before the end of 2025. Securing that financing is obviously crucial for funding that major project.
Right, that FLNG facility, plus the RWS 2.0 projects we talked about, the New York expansion plans. It all points to very significant capital expenditures, or CapEx. What do the capital commitments and CapEx figures in the report tell us about their planned future spending and how much they're investing right now?
This is where you really see the scale of Genting's ambition and their strategic bet on future growth. As of March 31st, 2025, their authorized capital commitments, that's planned future spending not yet provided for in the financial statements, totaled a massive RM 20,641.8 million.
Wow, over 20 billion ringgit in planned future spending.
Yes, it's broken down into RM 12,961.2 million that is already contracted, meaning they've signed the deals for this spending, and another RM 7,680.6 million that is authorized but not yet contracted. It's a huge pipeline of planned future investment across the group.
And how is that massive commitment broken down? Where's the money going?
The breakdown shows the vast majority, RM 18,765.5 million, is allocated for property, plant and equipment, or PP&E. This would cover those major developments like the RWS 2.0 expansions, other resort upgrades, new property developments, things like that. Another significant chunk, RM 1,651.8 million, is for rights of use of oil and gas assets, clearly pointing to the capital intensity of that Kazuri FLNG project we just mentioned. Smaller amounts are allocated for lease assets, investments, and intangible assets.
Okay, that's the planned future spending. What about actual cash going out the door on CapEx during Q1 2025?
In terms of actual spending during the first quarter, acquisitions of property, plant, and equipment totaled RM 1,067.5 million. So over 1 billion ringgit spent just in Q1. The YouTube source provided some context from the previous year, noting that 2024 capex jumped significantly to RM 3.93 billion, up from RM 2.72 billion in 2023. That jump obviously impacted their free cash flow. This Q1 25 figure of over RM 1 billion shows that this high level of capital spending is definitely continuing into the new year, reflecting their strong commitment to executing these large-scale projects.
So the company is clearly in a heavy investment phase, pouring significant capital into these large-scale projects, particularly in their core LNH and O&G segments. This requires substantial funding, and as we saw in 2024 and continuing into 2025, it has implications for their cash flow.
What about returns to shareholders then? Things like dividends or share buybacks, especially in the context of this heavy investment phase.
Well, the Q1 2025 Statement of Changes in Equity does show the payment of the final dividend for the financial year 2024. That amounted to RM 192.529 million paid out to shareholders during Q1. However, the YouTube source noted that the total dividend for 2024 was cut to 11 cents per share, down from 15 cents in 2023, and they linked this reduction directly to the lower profit the group saw in 2024.
So the dividend payout seems linked to earnings performance.
It suggests that, yes. Regarding share buybacks, the balance sheet shows a Treasury shares balance of RM 221.206 million as at March 31st, 2025. This indicates they have engaged in share buyback activity in the past, but there's no mention in the Q1 25 report of any new share buyback activity having occurred during this specific quarter. Okay, so what should you take away from this look at Genting Berhad's financials, the listener? The company is managing a substantial level of total liabilities, with notable finance costs impacting profitability, even though those costs saw a slight dip this quarter. Crucially, they are committing and spending heavily on large-scale, capital-intensive projects like the RWS 2.0 expansion, the FLNG facility, and their U.S. developments.
Right. This level of investment requires significant funding, contributes to their debt levels, and impacts free cash flow in the near term, as highlighted by that jump in capex in 2024 and the continued high spend we saw in Q1 25.
It really feels like a period of building and investing heavily for the future, doesn't it? Which demands significant upfront capital outlay. It's somewhat similar to undertaking a massive renovation and expansion of a large property. Costs a lot up front, can cause disruption, but the intention is clearly to improve the asset and its earnings potential in the long term.
That's a good analogy. And beyond the internal numbers, the projects, and the financial structure, it's absolutely crucial to consider the external environment in which Genting operates. What are the broader macroeconomic trends? What's happening on the regulatory front? And what are the key risks the company itself highlights in its reports? These external factors play a huge role in shaping their performance and their outlook.
Right. Let's look at the backdrop first. What's Genting's view on the global and regional economic and tourism environment they are operating within? What kind of mood music are they hearing?
Well, the company's press release sets a generally cautious tone. They mention ongoing global uncertainties and international trade and market volatility. Specifically for Malaysia, they expect economic growth to proceed at a slower pace, noting that heightened geopolitical tensions are weighing on sentiment. More broadly, they see global economic growth remaining uneven, with divergent trends across different regions, and they feel downside risks persist, especially amid those geopolitical tensions and global trade frictions.
What about inflation? That was a big topic last year.
The 4Q24 report provided context on the inflationary environment being influenced by domestic policy measures in Malaysia, and the YouTube source explicitly linked inflation to higher operating costs back in 2024. So the implication is that cost pressures remain a factor influenced by the broader macro environment. And specifically for their plantation segment, they noted that subdued crude oil prices might add to palm oil price volatility.
Okay, that's the general economic picture. How does that translate specifically to their core business, tourism, and gaming? What's their outlook there?
Here, the company expresses that demand for international tourism is expected to remain resilient. That sounds like a positive fundamental driver, right?
Yeah, sounds good.
But they immediately qualify this by saying that the recovery is anticipated to be uneven across regions, meaning different markets will bounce back at different speeds. Furthermore, and this seems important, they state that the regional gaming market may face increasing challenges.
Increasing challenges. That sounds a bit more negative than maybe previous outlooks.
It does seem like a noticeable shift in tone. The 4Q24 report, for comparison, expected the regional gaming market to maintain its recovery momentum. So this Q125 language suggests management is perhaps seeing potential new headwinds or maybe intensifying competition specifically within the gaming sector, even if overall tourism demand remains resilient. And we also heard earlier how the strong Singapore dollar and elevated travel costs continue to affect RWS non-gaming demand. That was a point carried over from the 4Q report, highlighting currency impact as a specific external challenge for that key market.
Okay. What about regulatory aspects? Anything new impacting their gaming operations in different countries? New taxes, rules?
Regulatory commentary in the Q125 report itself is somewhat limited in terms of announcing major new regulatory changes impacting them this quarter, but it does reference the impact of existing or recent regulations. For example, the RWS commentary noted that Q124 benefited from the relaxation of those visa regulations between China and Singapore back in February 2024. They highlighted this policy change as a factor that created that high base effect, making the Q125 comparison tougher.
But nothing on future China visa policy impact.
No explicit management commentary in the Q125 report, specifically on the future impact of China visa policies, just acknowledging the effects seen in the prior year comparison. We did hear about the positive outcome in Las Vegas, though the finalization of that NGCB complaint in March 2025, which is expected to allow RWLV to potentially recover and reestablish VIP play. That's a positive regulatory resolution.
And in the U.S.?
As part of their growth strategy, G&M is monitoring and preparing to participate in that New York Gaming Facility Board RFA process for the new casino licenses. That's a significant regulatory-driven opportunity they're pursuing. And the 4Q24 report also mentioned GNS monitoring the potential legalization of casinos in Thailand. That's an ongoing regulatory development elsewhere in the region that could alter the competitive landscape down the line.
Okay. Given these external factors and potential challenges, uneven recovery, increasing gaming challenges, currency issues, what kind of mitigation strategies does management highlight in the report? How are they planning to navigate these potentially choppy waters?
The stated mitigation strategies seem generally focused on managing what they can control internally. They talk about implementing prudent cost management and maintaining an agile approach to adapt to changing conditions that was mentioned for RWG and G&M overall. For RW Bimini, the focus is explicitly on optimizing operations and controlling costs. The GNS Group commentary highlights a prudent and adaptive approach, emphasizing leveraging their strong regional presence and financial strength to navigate those macroeconomic headwinds and geopolitical tensions.
So the emphasis is really on internal levers.
Yes, it seems the emphasis is clearly placed on operational efficiency, tight cost control, and leveraging their financial resilience as their key strategies to try and weather these external storms and manage the risks they face.
Okay. Based on all this commentary then, the macro outlook, the tourism and gaming specifics, the challenges they've mentioned, what would you identify as some of the key risks Genting Berhad is facing right now, as highlighted or at least implied by the sources we have?
Drawing directly from the source commentary, the key risks seem to include, first, the potential for that uneven tourism recovery and the increasing challenges they specifically highlighted in the regional gaming market. Second, the broad macro headwinds they mentioned, those ongoing global uncertainties, geopolitical tensions, trade frictions, and slower economic growth in some key markets. Third, currency fluctuations are an explicit risk, stated as having impacted Q125 results directly. Fourth, operating and payroll cost inflation seems an implied risk from the commentary about rising expenses hitting EBITDA in the UK and US LNH segments. Fifth, intense competition is noted in areas like their downstream plantation segment and specifically in the New York gaming market they're trying to expand in.
Any others?
Yes, there are also those specific operational issues like the impact of the RWS renovations, the inherent volatility of the VIP win rate in Singapore, which can swing results significantly, and the impact of the timing of festive seasons on visitation numbers. Then there's the significant litigation related to RW Bimini seeking over USD $600 million. That's material ongoing risk explicitly disclosed and needs careful monitoring. And finally, for the non-LNH segments, there's the reliance on volatile commodity prices, palm product prices for GNP, and crude oil prices for the O&G segment. Those seem to be the core external and operational risks highlighted or implied in the reports.
So what does this section tell you, the listener? Genting Berhad is operating in a global environment that, while recovering from the pandemic, is far from smooth sailing. They're navigating a choppy macroeconomic environment, dealing with currency volatility that directly impacts their reported numbers, and facing what they themselves describe as increasing potential challenges, specifically in the regional gaming sector, even if overall tourism demand holds up. Their strategy to deal with this seems heavily centered on controlling what they can internally, primarily through tight cost management, optimizing operations, and leveraging their financial strength to manage these external pressures and risks.
Absolutely. And as we've emphasized throughout this discussion, Genting isn't just a gaming and resorts company. It's a genuine conglomerate with diverse interests spanning several different industries. So let's take a moment to look at how those non-leisure and hospitality parts contributed in Q1 2025, and importantly, how the different pieces of this vast group actually interact with each other.
Right. We saw the individual segment results earlier, but just to recap, how did those non-LNH segments, power, plantation, oil and gas, and property perform in terms of contributing to the group's overall EBITDA this quarter, and what role do they really play in the bigger picture?
Okay, based on the segment results we discussed, Power showed a strong positive contribution to EBITDA in Q1 25, and importantly, significant growth year-on-year. This highlights its value as potentially a steady income stream, particularly from its Indonesia and China operations, with positive prospects mentioned for the India wind farm too. Plantation also provided a solid positive EBITDA contribution, and again, strong year-on-year growth, despite slightly lower revenue. This demonstrates its value as a key agricultural asset, although its performance is influenced by volatile commodity prices and production levels. Oil and gas contributed positive EBITDA, although it was down year-on-year. This segment represents the group's involvement in energy extraction and development, with that big FLNG project being a significant future prospect for them. Property also had a positive EBITDA contribution, although it was lower year-on-year, it did see a very strong quarter-on-quarter jump. And the investments and other segment, while reporting an EBITDA loss, showed very significant improvement both year-on-year and quarter-on-quarter, reducing the drag on the group's bottom line compared to previous periods.
So while leisure and hospitality is clearly the dominant force in terms of scale, these non-LNH segments did provide meaningful positive EBITDA contributions in Q1 25. And they offer that crucial diversification across different industries, right? Which can help buffer the overall group performance when the core LNH segment faces headwinds like it did this quarter year-on-year.
Exactly right. They provide some balance and diversification.
Now, the sources also list a large number of what they call related party transactions, or RPTs. These seem to be transactions between different parts of the Genting Group and also with entities connected to key shareholders. What does that extensive list tell us about how interconnected these businesses are and maybe about the group's overall structure?
Yes. The sheer volume and variety of related party transactions listed in the financial report footnotes are quite extensive, and they really demonstrate how deeply intertwined the operations are within the complex Genting Group structure. They're a key indicator of how this conglomerate actually functions internally. We see numerous examples listed in the Q1 report, such as various licensing fees being charged between entities for the use of key brand names like Genting and Resorts World. This shows how the core intellectual property is managed and monetized within the group, with subsidiaries essentially paying the parent or related entities for the right to use these valuable brands.
Okay, that makes sense. What else?
Management and support services being provided across the group. For instance, the report mentions the parent company providing services to the RWI group, or a Genting Plantation subsidiary providing specific management services to Genting Malaysia entities. This suggests shared services and maybe centralized functions supporting disparate businesses across the globe.
Like shared back-office functions.
Potentially, yes. Also, licensing and management fees charged by entities related to specific F&B or entertainment concepts. The example given was Zouk entities charging fees to Resorts World Las Vegas for using their brand and expertise. This highlights how successful concepts developed in one part of the group can be leveraged and rolled out across other properties.
Internal synergy, almost.
In a way, yes. We also see sales of products between subsidiaries, like a Genting Plantations refinery selling refined palm oil products to another entity noted as related. This shows internal supply chain activities. Provision of services like entertainment RW Cruises, providing show performers to the Genting Malaysia Group, and even transactions between group entities and entities connected with significant shareholders. The report mentions things like maintenance, construction, water, and electricity services provided by companies connected with a shareholder of BB Entertainment Ltd, the operator of RW Gimini, to the Genting Malaysia Group.
Wow, that is quite a list of interactions. It really paints a picture of a complex web of intercompany dealings and relationships. Do the sources explicitly talk about the strategic synergies that result from all this interconnectedness beyond just listing the transactions?
That's a good question. The sources primarily just list these transactions, as they're required to do for financial reporting disclosure. They detail the nature of the transaction and the value involved. Now, the rationale provided for that recent material event, Genting Malaysia, acquiring the remaining 51% of Empire Resorts LLC from Kienhuat Realty 3, Limited does explicitly mention realizing synergies, cross-marketing opportunities, and sharing resources and knowledge between RWNYC and Empire once they achieve full ownership. That's one specific example where a strategic benefit, synergy, is directly stated in relation to a related party transaction.
But not for the broader group.
Right. For the broader group and the vast number of other listed RPTs, the report doesn't generally spell out detailed, overarching strategic synergies. Things like, say, bundled loyalty programs across different international properties, or specific integrated offerings leveraging perhaps the plantation business with the resorts. The transactions themselves clearly demonstrate the operational linkages and the group's complex structure, but the strategic advantages derived from every single interaction are mostly left implicit in the reporting, other than that explicit mention related to the Empire acquisition consolidating the NY assets.
So for you, the listener, the key takeaway here is that Genting Berhad is truly a diversified beast. Those non-gaming segments provide meaningful contributions and important diversification, and the numerous related party transactions listed in the report highlight the deep operational connections and the intertwined nature within this large, complex group. While specific strategic synergies aren't always explicitly detailed for every single transaction, the structure clearly allows for and relies upon these internal dealings as fundamental to how the conglomerate operates.
Exactly. Now that we've thoroughly unpacked the Q1 2025 results, looked at all the segments, financial structure, the external environment, and the conglomerate nature, let's turn to the outside view. What are the analysts saying based on these numbers and the company's outlook? What's their current take on the stock following this report?
We have excerpts from 3 analyst reports provided in the sources. What are their current ratings and target prices for Genting Berhad? And crucially, have they changed their views after seeing these Q1 numbers?
Okay, we see a bit of a mix of views here, which is interesting. HLA Research maintains a BUI rating. However, they have lowered their target price quite significantly, down to RM 4.44 from a previous RM 5.25. Based on their report's current price reference of RM 3.13, this still suggests a pretty high expected total return of 46.1%. They also maintain an overweight rating on the broader gaming sector. Public Investment Bank, on the other hand, has a neutral rating. They've also lowered their target price down to RM 3.50 from a previous RM 5.0. Using their similar current price reference of RM 3.13, this implies a much lower expected return of just 11.8%. And they rate the sector neutral. TA Securities also has a BOI rating with a target price of RM 3.56. They note this suggests a 13.7% upside from their last traded price reference of RM 2.73. Just noting the slight difference in current or last traded prices cited across the reports, likely reflecting the price when each report was published.
Okay, so we see both BUY and neutral ratings. But it seems all 3 firms that provided a prior target price in the sources have actually reduced them following this quarter's results. What reasons do the analysts specifically give for their ratings and, perhaps more importantly, for lowering those target prices? Was it just the headline miss?
Well, HLI Research maintained their BUI rating despite lowering the target price. While the specific reasons for the target price reduction aren't fully detailed in the excerpts we have beyond the context of the results review, the report explicitly notes the weaker Q1 FY25 results, which they say were primarily dragged down by Genting Malaysia and Genting Singapore. So the weaker performance is clearly factored in.
And the others?
Public Investment Bank is very explicit. They state disappointing results right up front as the reason for their neutral rating and their lower target price. Their detailed review section clearly states that Genting Berhad's Q1 25 core profit of RM 76.9 million came in below market expectation. And they say this earnings miss was largely due to lower than expected contribution from gaming operations across Singapore, Malaysia, the UK, and Las Vegas. So for Public Bank, the disappointing performance from the core gaming units directly led to their less optimistic valuation and their neutral stance.
And TA Securities, they had a BUY rating too, right?
Yes, TA Securities also noted that the Q1 25 core profit was below market expectation, that the earnings miss was due to lower than expected gaming contributions, and that adjusted EBITDA slumped year on year. They acknowledged the weaknesses. However, despite this, TA Securities maintains its BUI rating.
Interesting. Why maintain BUI if the results were disappointing?
Well, the report doesn't explicitly state their reasoning for maintaining the BUI despite the weak quarter in the excerpt provided, but it suggests that while they recognize the weak quarter, they might see the current share price valuation as attractive relative to their longer-term outlook. Or perhaps their sum of parts valuation, which we'll get to, still indicates enough upside potential to justify a BUY rating despite the near-term headwinds reflected in the results.
That difference in opinion is really key, isn't it? Some analysts seem to see the recent dip or the current price as a buying opportunity, maybe looking past the quarter, while others are more cautious and taking a neutral stance given the disappointing performance relative to what the market was expecting. How do the analysts actually approach valuing such a complex conglomerate like Genting Berhad? It's not straightforward.
No, it's not. Given the conglomerate structure with distinct, often separately listed subsidiaries, analysts frequently use a sum of parts (SOP) valuation approach. Essentially, they value the different subsidiaries or segments separately, like Genting Malaysia, Genting Singapore, the plantations business, maybe even RWLV, and then they sum up those individual valuations. They often apply a holding company discount to the final sum to reflect the conglomerate structure.
What methods do they use for the individual parts?
The sources show they use various methods. HLI's SOP, for example, includes valuations for Genting Malaysia, Genting Singapore, Genting Plantations, and Resorts World Las Vegas. They seem to use a mix of methods like SOP for the listed subs, EV/EBITDA multiples, enterprise value to earnings before interest, taxes, depreciation, and amortization, and potentially DCF, discounted cash flow analysis. TA Securities also provides a detailed SOP breakdown. They use DCF for Genting Singapore and Genting Malaysia, but apply a PER, price-to-earnings ratio, multiple for Genting Plantations, Power, and the oil and gas segments.
So different methods for different parts. Do they look at overall group metrics too?
Yes. TA Securities also looks at overall group financial indicators, like projected net-debt-equity ratios. They forecast 2.4x for FY25 and 0.3x for FY26, and the price-CEN-A net tangible assets ratio, which they note is around 0.4x. They specifically discuss the overall group PE ratio, noting the current PE was 14.41x, but the forward PE, based on analyst consensus estimates, was much lower at 8.29x. They highlight the historical volatility of Genting's PE ratio and explicitly pose the question of whether the stock is currently undervalued based on this metric.
So the investment narrative coming from the analysts seems to revolve around acknowledging that Q1 25 earnings miss, which was primarily driven by the gaming operations performing below expectations, but also considering the company's future prospects and the current valuation. What's the general outlook commentary from the analysts and the company itself?
Well, the analyst reports consistently note the earnings miss in Q1 25 and clearly link it to the gaming performance. The company's own prospects commentary, as we discussed earlier, highlights cautious optimism for the near-term leisure and hospitality sector, but remains pretty positive on the longer-term outlook. They're focusing heavily on executing those key projects, enhancing RWG, completing the RWS 2.0 transformation, expanding their U.S. presence with the Empire acquisition and pursuing the NYRFA, and driving visitation and operational efficiencies in the U.S. and Bahamas.
And the other segments.
Right. The non-LNH segments like GEMP, Power, and ONG also have specific prospects tied to their respective markets and ongoing projects, like that big FLNG facility. The YouTube source we mentioned earlier framed the question around whether Genting Berhad is a potential hidden gem at its current price, discussing its financial journey, the revenue comeback post-pandemic, but also the dipping profits and climbing debt observed in 2024, and using the PE ratio as part of that valuation discussion.
So for you, the listener, the analysts have presented mixed views following this Q1 report. That led them to lower their target prices across the board, but there's still a divergence between BUY and neutral ratings. This difference in opinion often comes down to how they weigh the temporary setbacks and macroeconomic risks highlighted in the report against the long-term potential offered by Genting's large-scale development projects, the prospects for recovery in key markets, and those current valuation metrics like PE and percenta. It's really up to you to consider these different perspectives and valuation approaches alongside the raw data and company commentary we've discussed today.
Absolutely. And beyond the quarterly numbers and the analyst interpretations, it's also important to be aware of any significant events that happened after the quarter ended on March 31st, and also any major legal issues the company is facing. These are often called material events because they can impact the company's future, even though they aren't reflected in the Q1 results themselves.
Right, things that happen after the books close for Q1. Let's start with those subsequent events, based on what's in the Q1 2025 report. What happened between April 1st and the report's release date that's noteworthy?
Okay, the report highlights 3 material events that occurred after March 31st, 2025. First, on April 28th, Beni Restu Berhad, which is a wholly owned subsidiary of Genting Plantations, GNP, successfully issued RM 300 million in those Islamic medium-term notes. the Sukuk Murabaha. They have a 5-year tenure at 3.88% per annum. This just shows ongoing activity in managing the financing requirements of the plantation segment.
Okay, financing activity. What else?
Second, and this one seems perhaps more strategically significant, on May 1st, Genting ER Limited, an indirect wholly owned subsidiary of Genting Malaysia, GEM, entered into an agreement to acquire the remaining 51% membership interest in Genting Empire Resorts LLC, GRL. They're buying it from Quinhua Realty 3, Limited, for a cash consideration of USD 41.0 million. This consideration includes accepting the assignment of a USD 39.7 million intercompany loan.
And Quinhua is a related party, right?
Yes. Quinhua is ultimately linked to the Lim family, the controlling shareholders of Genting. This acquisition is still subject to regulatory approval from the New York State Gaming Commission. But upon completion, GER and its subsidiaries, which own Resorts World Catskills and have interest in the NY Mobile Sports betting license, will become indirect, wholly owned subsidiaries of GEM.
What's the stated reason for this move? Why consolidate now?
The stated rationale is to reinforce the G&M Group's position and grow its presence in that crucial New York market. They want to compete more effectively in the northeastern U.S., and they believe they can fully realize synergies, cross-marketing benefits, and share resources and knowledge between Resorts World New York City, RWNYC, and the Empire assets once they achieve full control. It's about strengthening their hand in New York.
Okay, that makes strategic sense. What was the third event?
Third, on May 19th, the disposal of 2 parcels of land by GEMP subsidiaries to a company called Scientex Heights was completed. This brought in total cash consideration of RM 267.42 million. This wasn't entirely new. It was actually a follow-up event from something mentioned in the 4Q24 report where the conditional sale and purchase agreements were first signed. So this is the deal closing.
Got it. So that Empire acquisition is definitely a notable strategic move for the Genting Malaysia segment, consolidating ownership in that important New York entity and aligning with their broader U.S. growth strategy. Now, turning to litigation, are there any material legal cases that were highlighted as ongoing concerns in the Q1 report?
Yes, there is one material litigation case that is explicitly mentioned as ongoing in both the Q125 and the prior 4Q24 reports. It involves Genting Americas, Inc., GAI, which is an indirect wholly owned subsidiary of Genting Malaysia, GNM. GAI is named as a defendant in a complaint that was filed by a company called Rabzi Bahamas Ltd. Way back on October 7, 2024. This was filed before the U.S. District Court for the Southern District of Florida.
And what does this lawsuit involve?
It involves the operations of Resorts World Bimini in the Bahamas. To give some context, an entity called BB Entertainment Ltd., ABEL, owns and operates RW Bimini. Genting Malaysia indirectly holds a 78% interest in BBL, while this Ravi company holds the remaining 22%. GAI, the defendant, is noted in the report as a related company of BBL.
Okay, so it's a dispute involving the minority partner in the Bimini Resort. What exactly is Rav Bahamas seeking in this lawsuit? And what's the scale of the claim? That's usually the important part.
It is. Rav Bahamas is seeking damages in excess of USD 600 million in this lawsuit.
Over 600 million US dollars. Wow. That is a very significant amount for a material litigation case. What's the current status of this lawsuit? Where does it stand?
Well, GAI filed a motion to dismiss the complaint back on November 22, 2024. They argued on multiple grounds, including that the dispute is fundamentally a shareholder dispute that should really be addressed in a different forum based on the shareholders' agreement between the parties. They also argued that some of the claims are time-barred, and that the complaint simply fails to adequately allege the necessary facts to support each claim being made. Despite the motion to dismiss, the report states the case is currently proceeding into what's called fact discovery, where both sides gather evidence.
Is there any kind of mediation or settlement process involved?
Yes, mediation is required by the U.S. court local rule in this particular jurisdiction. According to the 4Q24 report, mediation was actually scheduled for May 8, 2025. The Q125 report confirms that mediation is scheduled or in progress, and the 4Q report also noted that the parties had already selected a mediator. So this indicates that efforts towards potential settlement discussions are definitely underway as part of the formal legal process.
And what is Genting Americas Inc.'s official stance on the complaint and the huge damages being sought?
Genting Americas Inc. has stated firmly in the report that it believes the complaint is baseless and without merit, and they state that they will continue to vigorously defend against these claims.
Okay. So for you, the listener, while the core quarterly report covers performance up to March 31st, it's really important to be aware of these notable developments that occurred afterwards, like the GNP Sukuk issuance for financing, and maybe more importantly, that strategic empire acquisition by G&M aimed at consolidating control in the New York market. And critically, that very significant multi-hundred-million-dollar litigation related to Resorts World Bimini is a material event that remains ongoing and is proceeding through the legal process, with mediation having been scheduled recently. These subsequent events and the potential financial exposure from that litigation are important factors outside the direct Q1 numbers that really paint a fuller picture of the company's current situation and future considerations.
Absolutely. And finally, let's just touch briefly on the non-financial aspects covered in the sources specifically, their approach to environmental, social, and governance factors, what's commonly referred to as ESG. While these aren't directly tied to the Q1 numbers, analysts often provide commentary and even ratings on these areas nowadays, and they can be important for many investors.
Right. ESG is increasingly on the radar. What kind of overall ESG rating do the analyst reports provide for Genting Berhad? Do they give a score?
Yes, both TA Securities and HLI Research give Genting Berhad an overall ESG rating of Orium, which is a 3 out of 5 score. According to TA Securities' guideline explanation, this rating indicates adequate integration of ESG factors into their business, and it results in no specific change to their target price based on ESG alone. So it positions them kind of in the middle of the range, not outstanding, but not poor either.
Okay, a middle-of-the-road rating. Let's look at the components quickly, starting with the social indicators, the S in ESG. What do the sources highlight here?
In terms of social factors, the sources note that the group is a major global employer with over 47,000 employees worldwide, and they provide a general breakdown of employee percentages by subsidiary. One specific metric highlighted is the female board of directors composition, which is 12.5%. HLIV Research points out that this figure is the same as it was back in 2020. And they note that under the Malaysian Code of Corporate Governance, which suggests a target of at least 30% female directors for large companies, this is an area where improvement is needed for Genting Berhad.
Okay, board diversity is 1 point. What else?
The overall employee gender mix across the group is reported as 67% male and 33% female. The employee turnover rate was noted as 17%. Average training hours per employee, specifically for Genting Berhad itself, was 15.1 hours. The reports also mention efforts around responsible gaming across their properties, things like RWLV conducting training during new hire orientation and refresher courses, RWG implementing voluntary self-exclusion programs for patrons, and RW Catskill having a dedicated responsible gaming resource center. Interestingly, the TA Securities report includes a commentary point acknowledging the broader social context of their core business, stating that gambling addiction affects individuals and families and can be a boon to certain unlawful activities like illegal money lending.
So while they have responsible gaming programs, board gender diversity is flagged by analysts as an area needing improvement compared to recommended standards. What about governance factors, the G? How do they score there?
For governance, the sources note the board size is 8 directors, with 62.5% reported as independent, both figures apparently unchanged from 2020. The average board tenure is 10.8 years, and meeting attendance was reported as 1%. However, HLI Research raises some specific governance concerns, particularly regarding director independence and committee roles.
Oh. What are the concerns?
They note that one director classified as independent, Dato Dr. Arthur Lanathan, has actually served on the board for 18 years. This tenure is beyond Bursa Malaysia's 12-year term limit for independent directors, which came into effect from June 1, 2023. Based on this rule, HLAB effectively reclassifies this director as non-independent in their analysis. And based on this reclassification, they calculate the actual independent director composition on the board to be only 50%, not the reported 62.5%.
And does this director hold key committee positions?
Yes, that's the other point HLA raises. This same long-serving director, Dato Dr. R. Thilanathan, chairs both the Audit Committee and the Nomination Committee. HLA's view is that the Audit Committee, which oversees financial reporting and internal controls, should ideally be chaired by an independent director and comprise solely independent members for objective oversight. They also note that under the Malaysian Code of Corporate Governance, the board chair should not be a member of the Audit, Nomination, or Remuneration Committees, precisely to ensure independent and objective oversight of the board's composition and executive pay.
So HLE sees a potential concentration of power and maybe a lack of fully independent oversight in key committees.
That seems to be their concern, yes. The reports also mentioned that there were noticeable votes against the re-election of this particular director. Dato Dr. Arthalanathan, at the June 2022 AGM, 16.2% voted against. HA suggests this was likely linked to these very reasons regarding his long tenure and committee chair roles. HA Live also highlights a concern they term overboarding, noting that the executive directors Tan Sri Lim Kok Thay and Mr. Lim Kyung Hui serve on more than one other listed company board, which can potentially raise questions about the time and attention they can dedicate fully to Genting Berhad.
Okay, so some specific governance structure concerns raised by analysts. Any positives on governance?
On a more positive governance note, the TA Securities commentary mentions that Genting Group winning global regulatory awards indicates they have taken proactive measures regarding anti-money laundering directives. This suggests strength and compliance in that important area.
Right. So while they appear recognized for compliance in areas like anti-money laundering, there are definitely specific questions raised by analysts about the board structure, director independence, and committee roles based on governance best practices and Malaysian rules. Finally, what about the environmental indicators, the E? What do the sources say there?
The environmental aspects mentioned in the sources we have are primarily general commentary provided by TA Securities, reflecting on the inherent nature of some of Genting's core businesses. They state, for example, that the construction of large integrated resorts would require massive deforestation, acknowledging the significant land use impact that comes with building these huge developments. They also note that the extraction of oil and gas, which is part of their O&G segment, will cause serious air pollution, highlighting the unavoidable environmental consequences associated with fossil fuel operations. There isn't specific quantitative Q1 2025 environmental performance data provided in these particular sources, things like detailed emissions figures, energy consumption data, or waste management statistics for the quarter itself.
Okay, so for you, the listener, Genting Berhad receives that middle-of-the-road ESG rating of 3 out of 5 from the analysts. This rating seems to reflect some positive actions and compliance efforts, particularly noted around responsible gaming and possibly anti-money laundering. However, the detailed analysis, particularly from HLIB, reveals areas where improvement is clearly needed or where concerns are raised, especially regarding board independence, director tenure, and the structure of key governance committees. Furthermore, the analysts openly acknowledged the significant inherent environmental impact associated with their core businesses, like integrated resort development and O&G extraction, as well as the social dimension of gambling addiction. These are fundamental challenges intrinsically linked to the group's operations. These non-financial aspects provide important context for investors to consider alongside the purely financial performance.
Exactly. We've covered a huge amount of ground today, haven't we? Taking a really deep dive into Genting Berhad's first quarter 2025 report based on all the sources provided.
We certainly have. We started with those headline consolidated numbers, which showed that definite decline in revenue and EBITDA year on year. That was largely driven by the leisure and hospitality segment, especially down in Singapore, which faced those really tough comparisons and specific operational issues like the hotel renovations and that volatile VIP win rate. And we noted the currency impact also pulled those reported numbers down significantly.
However, we saw that positive swing quarter on quarter, didn't we? Moving from a loss back to a profit and seeing an improvement in adjusted EBITDA. That signals some recovery momentum coming out of the end of 2024. And we saw that beneath the surface, the different segments and regions had quite varying performance dynamics. Some of those non-LNH segments, like power and plantation, actually showed strong EBITDA growth year on year, contributing valuable diversification to the group.
We also explored their financial structure, seeing that the company is undertaking really significant capital-intensive projects like the massive RWS 2.0 transformation in Singapore and that big FLNG facility in the oil and gas segment. This is clearly reflected in those substantial authorized capital commitments and the significant cash outflows we saw for CapEx. It highlights that they are very much in a heavy investment phase right now, which requires significant funding.
And we looked at the external environment too, recognizing that Genting is navigating what seems like a challenging and uncertain macroeconomic backdrop. They're dealing with currency fluctuations that directly affect their reporting, and they specifically noted increasing potential challenges emerging in the regional gaming market, even if overall tourism demand remains resilient. Their stated strategy to mitigate these risks seems heavily centered on internal cost control and operational efficiency. And we also highlighted that significant multi-hundred-million-dollar litigation related to Resorts World Bimini that's a material ongoing event proceeding through the legal process that needs watching.
And finally, we touched on the analyst views, which were mixed following this quarter's results. It led to lower target prices from all analysts who provided them, but still left a divergence between BUY and neutral ratings. We also reviewed the ESG aspects, noting areas of positive effort and compliance, but also those areas of concern raised by analysts, particularly regarding board structure and independence.
So putting it all together.
Yeah.
Given the mixed financial results we saw down significantly year on year, but showing that sequential improvement quarter on quarter, given the fact that the company is clearly in a period of heavy investment in these large-scale future projects, given the presence of that ongoing material litigation related to Resorts World Bimini seeking very significant damages, and given the analyst's spotlight on specific governance matters, here's perhaps a final thought for you, the listener, to ponder. How do you weigh the potential long-term upside from these massive development projects, the eventual recovery of key markets, and the group's diversified asset base, against the very real near-term headwinds from macroeconomic uncertainty, the operational challenges we saw in key properties this quarter, the inherent execution risks that come with major CapEx programs, the potential financial implications of that ongoing litigation, and those specific governance concerns raised by the analysts? Does the company's current valuation, as discussed by the analysts, adequately reflect this complex balance of factors and risks?
That's certainly a lot to consider, well beyond just the headline numbers from one quarter. Thank you for joining us on this deep dive into Genting Berhad's 1Q 2025 report. We hope this detailed breakdown gives you a clearer picture of everything that's happening with this complex global group.